Welcome back, everyone. We're diving into a classic today, The Intelligent Investor by Benjamin Graham.
Oh, a classic for sure.
It was originally published way back in 1949. Can you believe it?
1949, huh?
Yeah. But here's the thing. People still swear by it. Like Warren Buffett, for example. He's one of the most successful investors of all time, and he credits a lot of his success to Graham's principles.
Right, right.
So our deep dive today is all about figuring out if Graham's wisdom still holds up in today's crazy market. Can these decades-old ideas really help us navigate all the wild swings and uncertainties we're seeing in 2024?
Yeah, I think a lot of people are wondering the same thing.
Especially since everyone's always looking for that get-rich-quick scheme.
Oh, tell me about it. It's everywhere you look these days.
But Graham, he doesn't promise any of that. His book is all about making smart, informed decisions that build real wealth, not chasing fads or taking unnecessary risks.
Yeah, he's not about the hype.
So let's get down to brass tacks. What exactly does Graham mean by intelligent investing?
Okay, well, in a nutshell, he says it's an operation that promises safety of your principal.
Okay, safety first. I like that.
Right. And a suitable return.
Suitable? Not outrageous or anything?
No, nothing crazy, just a reasonable return on your investment. But here's the kicker. It's all based on thorough analysis.
So you can't just throw darts at a stock board and hope for the best.
Aha, no, not quite. It's not about luck or hot tips. It's about treating investing like a business.
Okay, I'm intrigued. What does that even mean? Treating it like a business.
Well, it means understanding what you're buying, doing your research, looking at a company's financials, its management team, its long-term prospects, all that good stuff.
So it's not just about buying low and selling high. There's more to it than that.
Yeah, it's more nuanced than that. It's about value investing, finding those hidden gems that the market might be overlooking.
Okay, now we're getting somewhere.
Yeah.
So how do we find these gems? What's the secret sauce?
Well, Graham talks a lot about having the right mindset, which can be tricky, honestly.
Mindset. What do you mean?
He uses this brilliant analogy, Mr. Market. Imagine you have a business partner, Mr. Market.
Okay, I'm picturing him now. What's he like?
Well, he's incredibly emotional, totally unpredictable. One day, he's euphoric, offering you a sky-high price for your share of the business.
Wow, sounds like a good day.
Right. But the next day, he's in despair, practically begging you to sell your shares for pennies on the dollar.
Oh, so he's a bit of a roller coaster, this Mr. Market.
Exactly. He's all over the place, driven by his feelings, not by logic or reason. His offers are based on his mood swings, not on the actual worth of the business.
That sounds a little familiar, actually. Kind of like what happened with those meme stocks a couple of years ago.
Bingo. You got it. People were going crazy over companies with, well, let's just say questionable fundamentals.
Yeah, all hype, no substance.
Exactly. And Graham's point is this. Intelligent investors, they don't let Mr. Market's mood swings dictate their decisions.
So it's about staying cool, calm, and collected, even when everyone else is freaking out.
Ugh, exactly. Don't get swept up in the hype. Do your own research. Make your own judgments based on the facts. And most importantly, stick to your plan.
That sounds like good advice for life in general, not just investing.
It really is. Now, Graham also talks about different types of investors, active and passive.
Oh yeah, I remember reading about that. So which one's better?
Well, that's where it gets interesting. Graham doesn't say one is better than the other. He says it depends on you, the investor.
On me. How so?
It depends on your personality, how much time you have, how comfortable you are with risk.
So it's about self-awareness, knowing your strengths and weaknesses.
You got it. The key is choosing the approach that fits you best. Whether you're a hands-on investor who loves digging into financial statements or someone who prefers a more laid-back approach.
That takes the pressure off.
Yeah.
I don't have to be a stock-picking genius to be successful.
Not at all. What matters is being deliberate and thoughtful no matter which approach you choose.
Deliberate and thoughtful. I like that. Now, what about risk? That's something that always scares people away from the stock market. It seems so unpredictable and dangerous.
Oh yeah, I hear that a lot. But Graham actually challenges that whole idea. He says that market fluctuations, those ups and downs, they don't necessarily equal true risk.
Wait, really? Explain that one to me.
Okay, think about it this way. If you've invested in a solid company at a reasonable price, those short-term fluctuations shouldn't really bother you.
So it's about having confidence in your research and your choices.
Exactly. The real risk, according to Graham, comes from overpaying for a stock or investing in a company with shaky financials. That's where you can get into trouble.
So it's not about avoiding risk altogether. It's about understanding what kind of risk you're taking and whether it's worth it.
You got it. Now,
What?
this reminds me of all those companies during the dot-com bubble.
Oh, yeah.
You remember, right? All hype, no substance. Their stock prices were soaring, but their actual businesses, well, let's just say they weren't built on solid ground.
Yeah, they crashed and burned pretty spectacularly. So Graham's saying we need to look beyond the hype.
Exactly. He was really skeptical of chasing after hot trends or getting caught up in the euphoria of a bull market.
Makes sense.
He believed that true value comes from understanding a company's fundamentals. Its earnings, its assets, its management team, its long-term prospects, all of that.
Okay, that makes sense. But how do we, as everyday investors, actually apply these principles? Where do we even start?
Well, we can start with those different types of investors we were talking about.
Okay, you mean the defensive and enterprising investor?
Yeah, let's start with the defensive approach. You know, the folks who want to minimize risk and build a solid portfolio without having to spend all their time analyzing financial statements.
I think a lot of people can relate to that.
Right. So for the defensive investor, Graham emphasizes simplicity and consistency.
I like the sound of that. Simple and consistent.
Right. One of his key strategies is dollar cost averaging.
Dollar cost averaging. Huh. I've heard of that, but to be honest, I'm not entirely sure how it works.
It's actually pretty straightforward. Instead of trying to time the market, figure out the perfect moment to buy, you just invest a fixed amount of money at regular intervals.
Okay, so like every month or every quarter.
Exactly. So let's say you decide to invest $500 every month, no matter what the market is doing.
Okay, I'm following you. So what's the advantage of that?
Well, when prices are low, you're buying more shares, and when prices are high, you're buying fewer shares.
Makes sense. So it kind of averages out over time.
Exactly. It's
Yeah.
a way to take the emotion out of investing and just stay consistent.
So even if the market is volatile in the short term, I'm still building my position gradually.
You got it. And another key part of defensive investing is diversification.
Don't put all your eggs in one basket, right?
That's the one. Graham was a big believer in spreading your risk. He recommended investing in a mix of stocks and bonds.
And that's where index funds come in, right?
Bingo! Index funds are a great way to get broad market exposure without having to pick individual stocks.
Yeah, I've heard a lot about them. They seem pretty popular these days.
They are, and for good reason. They offer instant diversification. Plus, they tend to have very low fees.
Which is always a good thing.
Oh yeah, those fees can really eat into your returns over time, so index funds are definitely something to consider, especially for the defensive investor.
So that's the more hands-off approach. What about those of us who are ready to roll up our sleeves and get a little more involved, the enterprising investors?
Ah, yes. The stock pickers. This is where Graham's deep knowledge of financial analysis really shines.
This is where it gets interesting.
Right. He gives us this framework for identifying undervalued stocks, what he calls bargain issues.
Bargain issues, huh? Sounds like my kind of shopping.
Haha, right. He believed that by carefully studying a company's financial statements, you could find these hidden gems that the market was overlooking.
So we're not talking about just picking stocks based on a hunch or a gut feeling. We're talking about real detective work, right?
You got it. Looking for clues in the numbers. Graham was a master at dissecting financial statements, looking at things like a company's earnings per share.
Earnings per share, okay.
Its price-to-earnings ratio, its debt levels, working capital, all that good stuff.
So he developed a set of criteria to help him determine whether a stock was truly undervalued or just cheap for a reason.
Exactly. He wanted to make sure he was getting a good deal, not just buying something that was broken.
Can you give me an example of one of those criteria, something concrete we can use today?
Sure. One of his key metrics was the current ratio.
Current ratio. Okay, what's that?
It measures a company's ability to meet its short-term obligations, its bills. He looked for companies with a current ratio of at least 2.1, meaning they had twice as many current assets as current liabilities.
So that means they have enough cash on hand to pay their bills, even if things get tough.
Exactly. It's a sign of financial strength and stability.
Got it. What else?
Another ratio he liked was the debt-to-equity ratio.
Debt to equity. Yeah.
This one shows how much debt a company is using to finance its assets. Graham preferred companies with low debt levels.
Why is that?
Well, because too much debt can be risky. It can make a company vulnerable to economic downturns or changes in interest rates.
Ah, so it's about finding companies that are financially sound, not over-leveraged.
You got it. And I think it's interesting that Graham used these ratios to analyze companies like Chrysler and Northern Pacific Railway, well-known companies.
Yeah, I remember reading about that in his book.
It just goes to show that even big, established companies can become undervalued due to temporary setbacks or changes in market sentiment.
So it's about finding those opportunities that others might be missing.
Exactly. But it's not just about finding cheap stocks. It's about understanding why they're cheap and whether that cheapness represents a genuine bargain or a sign of trouble.
Okay, that's a good distinction. So it's about doing your due diligence, really digging into the numbers and understanding the story behind them.
Exactly. Now, Graham was also known for issuing warnings, pointing out potential pitfalls that investors should watch out for.
Oh yeah, he wasn't afraid to call out the risks. What were some of the red flags that he cautioned against?
Well, he was really skeptical of IPOs, those initial public offerings.
IPOs. But don't some IPOs offer incredible opportunities for growth?
Sure, some do. But Graham's point was that it's really tough to assess the true value of a company that's just going public.
How come?
Well, there's often limited financial history to go on, and the stock price can be really influenced by speculation and hype.
Ah, so it's a bit of a gamble then.
It can be. He believed that enterprising investors, the folks with more experience and knowledge of financial analysis, might be better equipped to handle IPOs, but even then, he urged caution.
So it's not for the faint of heart.
Definitely not. What else? Oh, he was also wary of companies with too much debt, unsustainable growth patterns, and a history of accounting irregularities.
Those sound like pretty serious red flags.
They are, and we've seen these warnings play out in real life, haven't we?
Yeah, like with the collapse of Enron.
Right, exactly. Or the subprime mortgage crisis.
Or even the dot-com bubble we were talking about earlier.
Exactly. All of these examples show us how important Graham's principles really are. They're timeless. Even in today's fast-paced, ever-changing world, the fundamentals of sound investing remain the same. Understanding value, managing risk, and thinking for yourself.
Thinking for yourself. I like that. It's about not just following the crowd or blindly trusting the expert.
Exactly. It's about doing your own research, forming your own opinions, and making decisions that are right for you.
It's interesting listening to you talk about Graham's approach. I'm struck by how much he emphasized the human element of investing. It's not just about numbers and formulas. It's also about understanding ourselves, our own biases, and how our emotions can affect our decisions.
You're absolutely right. Graham was a keen observer of human behavior, and he knew that fear and greed can really mess with our judgment. He emphasized the importance of having a disciplined temperament.
So it's about staying level-headed even when the market is going crazy.
Exactly. Not getting too caught up in the ups or too panicked by the downs.
Yeah, it's tough sometimes. It's easy to get caught up in the excitement or the fear, especially when you see everyone else reacting.
It is. It's like this herd mentality almost.
Totally. So how do we resist that? How do we develop that kind of discipline, that emotional detachment that Graham talks about? It sounds almost superhuman.
Well, Graham actually gives us some pretty practical advice. First, he says we need to have a really clear understanding of what we're trying to achieve.
Our goals, right?
Exactly. What are your financial goals? What's your time horizon? How much risk are you truly comfortable with? All of that.
Okay, so it's about having a plan, a roadmap for where I want to go.
You got it. And once you have that plan, the key is to stick with it, even when things get bumpy.
Easy to say, hard to do sometimes.
Oh, I know. Believe me, I know. But that means resisting the urge to chase those hot stocks or panic sell when the market takes a dip.
Oh, the panic selling, that's the worst. It's like suddenly everyone's an expert and they're all saying the sky's falling.
Yeah, and that's when you need to remember what Graham said about Mr. Market.
Ah, Mr. Market, our emotional roller coaster buddy.
Right. He's not always rational. In fact, he's often driven by fear and greed, just like the rest of us.
So his prices might not reflect the true value of a business.
Exactly. And that's why Graham tells us to be skeptical of all those predictions and forecasts you hear.
Don't believe everything you read, right?
Right. Focus on your own research, your own analysis, and most importantly, your own plan.
So it's about being independent, thinking for myself, not letting the crowd or the so-called experts sway me.
Exactly. And this is where patience comes in. This is a big one.
Patience, okay.
Graham really emphasized this. He said that investing is a marathon, not a sprint. You're in it for the long haul.
So we need to be prepared for the ups and downs and not expect to get rich quick.
Exactly. It's about building wealth gradually over time, and that requires patience, discipline, and a whole lot of resilience.
Resilience. I like that. It's about being able to bounce back from setbacks, not letting the market's mood swings throw you off course.
You got it.
Mm.
And one of the best ways to build that resilience is to diversify your portfolio.
Diversification. Spread the risk, right?
You got it. Graham was a huge advocate for this. Don't put all your eggs in one basket.
So even if one part of my portfolio isn't doing so well, other parts might be doing okay.
Exactly. It's like having a safety net, financially speaking.
And I bet it helps with the emotional side too, knowing that you're not overly exposed to any one particular stock or sector.
Absolutely. It can really help you sleep better at night.
So it sounds like Graham's approach to investing is really holistic. It's not just about the numbers. It's about understanding ourselves, our own emotions, and how they can affect our financial decisions.
It really is. It's about developing a sound investment philosophy that's grounded in reason, not emotion. It's about having a plan, sticking to it, and staying focused on the long term.
And ultimately, it's about taking control of our own financial destinies.
Exactly. And I think that's what makes Graham's work so timeless and so powerful. He gives us the tools and the mindset to navigate the complexities of the market with confidence and clarity.
Well, I have to say this has been an incredible deep dive into the intelligent investor. I feel like I have a much deeper understanding of what it means to be an intelligent investor, not just in terms of financial knowledge, but also in terms of emotional intelligence and self-awareness. Thank you so much for sharing your insights today.
It's been my pleasure. And I always find something new every time I revisit Graham's work. It's a true classic for a reason.
Absolutely. And I think the biggest takeaway for me, and hopefully for our listeners as well, is that investing is not just about picking stocks or trying to beat the market. It's about making informed decisions, managing risk, and ultimately building a future that's financially secure and personally fulfilling.
Couldn't have said it better myself.
So, to all our listeners out there, remember, you don't have to be a financial whiz to be a successful investor. What matters is having a plan, doing your research, and staying true to your own goals. And who knows, maybe you'll even find yourself thinking like Benjamin Graham before long.
Now that's a goal worth striving for.
That's it for our deep dive today. Thanks for joining us, and we'll see you next time for another fascinating exploration of the world of ideas.